Welcome back to Golden Rule Radio, your weekly recap of the metals markets and all the other markets and global events that affect the markets. We are sitting here on the heels of a very modest 25 basis point cut in federal funds rate, and the markets have strongly reacted. Tori, what's the recap look like?
Real strong reaction. I mean, I think the majority of the reaction is from his comments after the report that they were cutting rates. There's a lot of debate as to whether this cut was necessary or even healthy. I think there's a lot of pressure to explain why they continue cutting. I think behind the scenes, it certainly helps the banks. It certainly can stimulate the equities markets in some instances, but then he turned around and the things that he said were more hawkish, meaning higher rates for longer or even climbing rates. Dovish comments are that rates would be coming down, so he's been dovish here in terms of actions, but in terms of words, it's the opposite because he doesn't see any rate cuts coming in 2025. In one instance, they said at the most 2, but we have now lowered down to the 4.25% to 4.5% figure. And I'll tell you, Rob, I mean, the markets don't like the subsequent hawkishness because they're already topping. You're already at an end of the year. And that kind of tells you that's the end of the juice in a sense.
Yeah, honeymoon is over. The dollar rallied sharply above 108.
Yeah, big time.
Big time. Gold is down. It broke through modest support at around 2,620. We're at around 2,587 right now on gold. Silver broke below 30. And the Dow's down about 2.7% today. All the other stock indices are down as well. The NASDAQ, the S&P, the Dow Transports, they're all down. It looks like, as far as it affects us, the next stopping point for gold could be at 2570, but it really does look like we're looking at a short-term Fibonacci support at around 2535. 2540 range for gold. Whatever gold does, silver outperforms. I mean, gold's down over 2%, silver's down almost 4% today. So here we go. Hold on to your hats.
Well, this may be it. I mean, we've been hoping for a December pullback.
We did.
You know,
I mean, we've been talking about it for a couple of months now.
Yeah, we got that reversal. I'll tell you what's interesting is this pretty consistent trend post-election where you'll get it immediate reactive sort of heading one way or another, and then it'll reverse, and then it'll continue that initial one.
Yeah.
And then I think that we'll see it start to climb again after the first of the year. But this is healthy. This is necessary. This is certainly predictable when you see a dollar rally. I mean, the U.S. dollar's up 1.18 today to that 108.1. That's just a
big move.
Big move. And it's been a big move this week. Gold's off now almost $100 in a sense. You know, we're off 60 today. And silver at 29.37 with gold at 2,587 roughly. Now we're at an 88-to-1 ratio. So silver's drop, like you said, is even disproportionately more than gold's. It still screams buy silver. And every time we hit a ratio of about 90-to-1, it's followed by a silver rally.
Yeah.
So maybe all the more reason. Look at these opportunities as dips to buy. These are gifts. These are not fundamentals changing other than, yes, you're going to have a one-day reaction to a Fed announcement like this with the rate cut, but no expectation necessarily in the foreseeable future because he doesn't see inflation hitting the 2% goal as quickly as previously projected, right? That's just the Fed being wrong again. And everybody's been saying the inflation numbers have started to reverse. Inflation's going to be sticky. And again, if it weren't so necessary for the banking sector, I mean, this really does help the banks be more competitive. But Rob, it's not translating into like the 10-year yield on treasuries dropping. It's not translating into real interest rates dropping. The 30-year mortgage is, you know, relatively unfazed here and can't break free into a significant drop that might stimulate the housing market. Not that we need that, but you know what I'm saying? It's not really having the effects that I think that they were hoping for.
Well, and I think they were hoping for a more modest reaction from the stock market. I mean, the Dow now, I think it's a record 10 days in a row the Dow has been dropping. I mean, you'd have to go back to the 1970s to see a losing streak like that for the Dow Jones average. And it was off by quite a bit. And again, I mean, a rate cut typically is good for the stock market and you get a rally. And maybe he thought he could mitigate a modest rate cut and have a hawkish or bearish tone when he talked about the future of rate cuts. But boy, the market really reacted strongly.
Well, it did. The Dow, I mean, as we record here, 42,325 roughly, blink of an eye ago, we were at 45,000.
Yeah.
So the Dow's down 2,670 or so. I mean, that's
6%.
Yeah, that's huge. 2,670 points used to be catastrophic.
Yeah.
Now at these higher numbers, you have to focus on percentages. So I'm glad you put it into perspective. It's only 6%. But remember, a bear market technically is defined when there's been a 20% drop
right
in any one sector. And to your point, I mean, all the NASDAQ, the S&P, the New York Stock Exchange, they're all down 2.5% to 3% today.
Yeah, crazy day. And then on the good side, events in the Middle East seem to be calming down. Turkey is getting a little bit spicy with Israel, but I'm glad that seems to be calming down. It does look like Russia and Ukraine will be coming to the table fairly soon. So I think world events had little impact on these markets. It's all the Fed today.
That's right. And we're still a month away from an inauguration of a new president and a new administration coming in, and some of the cards are being shown. There are some expectations, but those fundamentals that you talked about, geopolitically and otherwise, those are going to have short-term impact on the metals. The longer-term push and pull is going to come from the bond yields and the U.S. dollar strength, and certainly economic and monetary policy, money supply, all those sorts of things. And so eyes on that. We did say last week that today would be a why gold type of thing. We're going to play that next week where you've got these underlying fundamentals. So if you want to know a little bit more about why does gold react the way it does, sometimes predictably, sometimes unpredictably, well, we'll go into that next week where we go into a deep dive on what causes the gold price to move in the short and the long term, those underlying fundamentals. But to recap again what you were saying on the charts, I mean, we put up a great chart that showed the 200-day moving average a few weeks ago. After we topped out at 2,800, we've been sort of whipsawing around here a little bit. And so again, right around 2,540 or so would be what's called the 618 Fibonacci retracement on that short-term chart. Mm-hmm. That last rally off of 2,300. So, and I apologize, actually, that's the 50% retracement level. And the 618 would take us down to below the 2,500.
Okay.
So right around 2,490. And it's not until we get to about 2,400, 2,420 that we see the short-term line up with the intermediate-term chart and that 200-day moving average. So for me, it wouldn't surprise me to see us come all the way down to that point. We may not. Again, it all is based on the news and the underlying fundamentals and how quickly we get there. But those are your three stops, 2,400, about 2,490, and about 2,540. Look at those opportunities.
Well, but also, when you look fundamentally, the Chinese central bank or the Chinese government bought 55 tons of gold just a couple of months ago. So the central bank buying doesn't depend upon the news cycle, which here in America lasts for a day or two, and then we're on to the next shiny thing. They are aggressively accumulating gold in the East. That supply is being taken off the market. So that changes things as things begin to clear and our vision for what's ahead and what the new administration is able to get done. We may find ourselves in a place where gold has a whipsaw sometime late January, early February, and makes its run in the spring like it typically does, and the supply isn't there.
Well, that's going to do it for this week's Golden Rule Radio. As always, thank you so much for tuning in. If you liked what you heard, hit that subscribe button or ring the bell. Our X account is at ICA Gold, and on Facebook, it's McIlvaney Financial. Our website, McIlvaney.com. But as always, the best yet is to give us a call at 1-800-525-9556. and we'd be happy to run through your individual portfolio with you. Thanks for listening.
Have a great Christmas. We'll see you next year.